Singapore Bank shares have always been a popular investment choice among investors, not just for their role in Singapore's growth, but also for their stable dividends, which have garnered a strong following of investors over the years. Hi everyone, my name is Huan Zi. I'm a Manager of Dealing and Investor Education at Phillip Investment Centre. Today we'll look at how Singapore's three local banks performed in Q3 2025 and how they can play a part in every investor's portfolio. Before we dive deep into each bank's results, this table summarizes the key figures announced by all three banks for Q3 2025. Let's start with DBS. Despite delivering a slight contraction of 2% year-on-year in profit, DBS profits beat expectation, largely driven by strong fee and trading income, even as margin pressure persisted. Its net interest margin, NIM, fell to 1.96%, reflecting the impact of lower interest rates. However, asset quality remains strong with a stable non-performing loan ratio. The dividend increase signals management's confidence despite the tough rate environment, and DBS' healthy balance sheets leave room for further payouts while maintaining a comfortable Common Equity Tier 1 Capital Adequacy Ratio, CET1 CAR. Overall, DBS' strength lies in its diversified earnings base, especially from wealth management and trading income. The main risks that remain are margin compression and macroeconomic or regulatory crosswinds. Moving on to OCBC, the bank's net profit was largely flat, as lower net interest income was offset by a strong rise in non-interest income. Its NPL ratio remains stable and is the lowest amongst three local banks. However, margins continue to be under pressure with NIM narrowing due to lower interest rates. Its 60% dividend payout ratio is set to end in financial year 2025, but a strong CET1 CAR level of 16.9% gives OCBC flexibility for potential capital management initiatives in financial year 2026, which could support dividend growth. Apart from the growth in non-interest income, the banks also have the fastest loans growth amongst peers, potentially benefiting from lower interest rates and SME sector growth. In short, OCBC offers a strong non-interest income story and regional growth exposure, though profit margins are under strain and the rate cut environment could limit upside. Last but not least is UOB. The bank has faced a severe drop in earnings as it built up a large provisions for potential loans losses, particularly in US and Hong Kong property exposure. While non-interest income and asset quality looks manageable, margin pressure and high provisioning dominate the narrative for UOB. UOB guided for financial year 2026 NIM in the range of 1.75% to 1.8%, with low single-digit loans growth and high single to double-digit fee income growth, with preemptive general provision being one of. Credit costs for UOB are expected to normalize. Although non-interest income was softer in 3Q25, the ongoing Citigroup portfolio integration in Malaysia, Indonesia, Thailand and Vietnam should support future fee income growth. UOB maintains 50% dividend payout ratio. However, this amount might be subject to earnings results. On a positive note, UOB has affirmed plans to return 3 billion of surplus capital to shareholders between financial year 2025 to financial year 2027 through dividends and share buyback. In summary, UOB's conservative stance offers protection, but near-term earning outlook is challenged by loan and margin compression. Comparing the three banks, DBS stands out for its resilience and diversified income. OCBC is holding steady mainly via fees, while UOB remains defensive, managing risk proactively amidst earning headwinds. All three banks remain strong selection options for proxy investment options into the Singapore economy. Their attractive dividend yields and strong fundamentals continue to draw income-focused investors. In summary, Singapore banks are navigating a challenging interest rate and macro environment. The key differentiators moving forward will be diversified revenue streams and cost discipline. For 2025 to 2026, expect continued margin pressure, loans growth challenges, and property credit risk. For investors, selecting banks with strong fee income, low credit risk, and good dividend yield will be critical. But as always, remember to exercise your own due diligence. That's all for this episode of PhillipCapital's Market Watch. If you found this video helpful, don't forget to like, subscribe, and stay tuned for more episodes. Thank you for joining us and see you next time.